Hi, and welcome to Random Rogers Big Picture for the week of December, December 9th. Moving right along, the year's just about up. Okay, a couple of things. First, up this week, a book plug. I got this in the mail yesterday. I think you can see that, the Dick Davis Dividend. I got this book for free. It kind of goes with having the blog. I get a lot of books for free. This is starting out pretty damn good. I'm going to suggest that this is one that's worth your time and efforts. It's a fat boy. It's going to take a commitment, but it's a pretty good book, at least so far. Okay. I said that I wanted to try to dig in a little bit to some of the concepts that were talked about at the Super Bowl of indexing that I went to last Monday. It's going to be a little difficult to really get into depth. There's a limit of 10 minutes, and even then I don't think YouTube can take the full 10-minute upload. But just to give you an idea of how meaty this stuff was, this was the textbook that they gave us. If you can get a feel for how thick that is, it's like the phone book for the town I live in. Very dense stuff. What they talked about, and there was a focus on specific things that I'm going to go over here. I made a list to try and remember most of them, but this is really a completely different mindset than a lot of what you see people on CNBC talk about, on the Fast Money Show, the Kramer Show. It's just a completely different mindset. The mindset is really the big picture. You've got an asset today. It's going to meet a liability in the future. Between here and there, that asset needs to be able to cover the liability when the time comes. That's something that's kind of a different way of what I've been talking about with regard to needing your money to be there in the future. What it does in a given year is not necessarily 20 years before retirement so important than where it stands when you need to go ahead and access the money. So there was a lot of talk about things like beta, how to increase beta, how to decrease beta, when to increase beta, when to decrease it, how to allocate some portion to getting alpha. It's a term called portable alpha, which is basically, look it up on Investopedia for a longer answer, but basically taking a portion of the portfolio, of your indexed portfolio is the context here, and putting it into something that's got a low correlation, just a slice, a low correlation to what you're indexing with, such that it increases the overall return. So, for example, if you have 80% in SPY, which not a recommendation, and then you put 15% into emerging market, and the emerging market skyrockets, okay, you've created a situation of portable alpha. I don't know the significance of the word portable. It doesn't matter to me. But so a lot of conversations along those lines. Things like hedging. There's a lot devoted to hedging. Things like doing a collar or doing a put spread. And really, there was a thing from Goldman Sachs. It was a lengthy presentation about going back and forth between the two, when to use one, when to use the other, the advantages, disadvantages in various conditions, on and on and on. Also talked a lot about exposure to different asset classes via the index route. And I want to stress that this was not an ETF conference. It was a conference on indexing. So it's a different type of thing than, ETFs are a subset of indexing, not the other way around. So there's this first thing that I've earmarked or dog-eared or whatever you call that, is all about international small cap dash a distinct asset class question mark. And it's page after page with all sorts of correlation data. And really the focus here is about what it does to the overall pie, how it, and this is something that I'm paraphrasing because this is the way I think of it, making tweaks at the margin to try to add performance. This is kind of an important thing. This is what people who manage much bigger pools of capital than I'm ever going to manage. I'm quite happy where I am. This is the type of thing that they are focusing on, is adding value through indexing, through different exposures. There was some talk, and it's actually in the Dick Davis book too, about 80% indexing, 20% active. Someone left a comment a long time ago about that, calling that the 80-20 solution. I don't know if I heard that phrase at the conference, but that's what they were talking about. There was a lot devoted to, I mentioned the put right index. I'll do my Seinfeld impression. Put right! About the put right index, there is a way to manage volatility, increase returns, that type of thing. So that really is the focus. It's not about stock picking. It's not bottom up. It's not chasing heat. It's about managing exposures, tweaking volatilities, and so forth. How to capture certain effects using futures. Buy right was another very popular topic in some of the stuff that's in this book. Benchmarking, an important thing. Are you using the right kind of benchmark? Which is kind of a popular topic on the blog sometimes in the comments, and that's a valid question. I always defend our use of SPY, and there's one reader who left some great comments who kind of has seconded this. I think he manages money also. I think it's one of the mics. That it's easy for clients to understand. That matters. That is relevant. Plus, it's easy to get information. This is certainly a true statement. It's very easy to get all the information you need about the constituency of the S&P 500, but benchmarking was a crucial thing in this conversation about blending benchmarks and so forth. Another one that went on and on and on is commodities. What sort of expected return can you get from commodities? Real returns, nominal returns, inflation, roll yield, all of this stuff, and it is really a very scientific application of how all of this can work. I was able to dig up a chart that kind of expresses, I think, graphically what this is about. I'm going to hold it up to the camera, and hopefully you can kind of see. The one here and here, you can kind of see here the market puking down versus here it not. So in this case, quite a bit of alpha, if you want to stick with the jargon, is generated here, probably from the use of hedging. It's a less graphic example on this side, but you can kind of see it. The market goes down a little bit versus flat here. So if there are a way to make this happen in your own portfolio, then that kind of is the focus of what was going on at the conference. So, logical question, how do you employ this sort of thing, if you even should, in your own portfolio? Well, I think this opens the door to thinking a lot about all sorts of things, like sectors, like exposures, how you manage volatility. Managing volatility is a huge theme in the portfolios I've managed. It's been a big help, knock on wood, this summer and up through the fall. And really, it should get you, hopefully, by kind of broadly going over, and really all I've done is tell you the things that managers of enormous pools of capital care about. Hopefully that gets you thinking to seek out more detail on this sort of thing, to learn how you can employ this. I'll write about some of this stuff maybe on the Sunday Post, but the thing here is focusing on the bigger picture, what it is you need the money to do over the longer term, and if that really is your goal, you're less hung up on this week or next week or whatever, and I think it's going to make it an easier way to kind of exist in the capital market also. So I won't say I learned a ton, but it kind of was a good reminder of kind of how complex this stuff can be. Some of these concepts I've been writing about, ever since the blog started. I think I think about it in a much simpler, less scientific manner than really the rocket science that goes into some of the stuff in this book. But it's crucial, and the fact is that as I've been able to implement it in portfolios without this, probably means that if you take the time to learn about it, you will also be able to learn and ultimately implement things that smooth out your ride, which really is what this is all about. Have a good weekend.